and we're almost at all-time highs in gold, and we're nowhere near all-time highs in silver, and it's kind of boring, and Bitcoin took all the show. There's a lot going on underneath the surface. As the largest weekly registered gold inflow ever on the COMEX. It's rivaled only by the March 2020 lockdowns. That is why gold open interest has increased by 130,000 contracts over the course of January. This does not count the spot deliveries that have happened in January, which is not an active delivery month, but still there are record amounts of deliveries for an inactive month in the gold futures market. There's never been a month like this. Something big is boiling. It's definitely going to happen this year. We're already on trajectory for it.
Before we show you more clips, smash the subscribe button and join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
The first thing we have is the second biggest month of COMEX registered gold inflows ever. This bar here, this blue bar, shows the monthly increase in registered supplies. Registered, of course, is gold for delivery against contracts, meaning it's for sale against futures contracts. Eligible gold is not. It is privately owned. Both are increasing. Registered gold even faster, which means that whoever is importing this gold expects to deliver it into a contract. Otherwise, they would remove the warrant from it. So we have here, it looks about to be between 0 and 5 million. So that's about 2.5 million ounces. That was only bested by, I think this is May or June 2020, when we had just below 5 million ounces. But this is the second biggest importation of registered gold supplies ever. And if we go to the weekly charts, we can see that this week was just about 2 million, just below 2 million ounces. This is pretty nuts. 2 million ounces of gold, and it touched that barely in one of the months of 2020. This could be maybe May, somewhere around April or May of 2020. I don't know which one is bigger, this one or that one, because the resolution is not big enough for me to tell. But you know what? It doesn't really matter. This week, what is happening is that this is a tariff dodge. Gold importers are trying to get away from the tariffs of the Trump administration, which will tariff everything that comes to the country, probably including gold bullion, but that has not been enacted yet. So these traders are trying to import, whoever they are, they're trying to import gold before the tariffs come into effect, and that is creating record amounts of gold importation, physical gold importation into the COMEX. If we go to this slide over here, this shows 133,000 new contracts in January on the COMEX. See here, in the 2025 begins, we're at about 450,000. Right now we're at 571,387, so that's about 133,000 new contracts. And this does not include the deliveries that have already been made, and I'll show you that in the next slide. My point here is that we usually see, after a surge in open interest like this in gold, the open interest falls down. As it falls down, what happens is that price falls with it. I don't think that's going to happen this time, because these increases in open interest are probably also tariff dodgers that are trying to get physical gold before the tariffs come in. And you know what? Those that open the contracts, they don't have to pay the tariff. The ones that import the gold have to pay the tariff. So I think people are importing gold into the COMEX in order to fulfill delivery on these contracts. So as the open interest on this falls, I think these deliveries are going to be made, and it's not going to affect the price. What affects the price as open interest falls is that longs sell their positions rather than taking physical delivery, and because they sell their positions, the dollar price moves. But on delivery, the dollar price does not move. The contract is satisfied by gold being delivered. So I don't think that that open interest falling is going to affect price negatively here. And if we move to the next slide here, we can see the monthly deliveries. This is 15,642. Isolated, this doesn't look like anything special, but this is a non-active delivery month. So 15,642 deliveries is a record, all-time record for gold deliveries in a non-active delivery month, right? There's active delivery months. They happen like every 2 or 3 months. It's usually like December, and then March or April. I think June is a popular one, but this is a non-active delivery month. So open interest is usually small. This is the most deliveries ever made for a non-active delivery month, which means that importers are trying to take delivery now, and they want to do this before the tariffs kick in. Now we're going to compare this with the open interest situation in gold during the 2020 crisis, the lockdown crisis, what happened here is we had near record high open interest, and then it slammed down from about 750,000 to 450,000. Let's just say 300,000 contracts, whatever that is. It's not exactly that, but it was a huge fall in open interest, and that was the gold crash that we all remember. And price went down from about 1,700 to 1,450. Price went down from about $1,700 to $1,450, somewhere around there. And we had this huge smash in open interest. We also had record deliveries. Now you could say, well, maybe that's going to happen this time. We're going to have a smash in open interest and a smash in the price and record gold deliveries. However, back then there was a huge dollar crisis, a dollar panic, because the world was shutting down and people couldn't service their dollar debts. That's not happening this time. We're not quite in a dollar crunch yet. So that means that there's not a rush for dollars. There's just a rush for gold before tariffs get in the way. And so as open interest falls here, as deliveries are taken for the active month, which closes in about 8 business days, 7 business days, 6 business days, something like that. January 30th is the last day. And open interest is still about 250,000 contracts. So I think that as we've seen record deliveries for a non-active delivery month, we're going to see record deliveries, I hope. In an active delivery month in all time, I think the record is 55,000 warrants delivered. I think it's going to be more if people are really trying to get around tariffs for gold importation. The subject I want to go into is a little bit on timing. We have the extraordinary accounting measures beginning yesterday. The Treasury has announced that the debt ceiling has been hit, and now it is spending down its account at the Fed, and those dollars are going to go back into bank reserves. So the last time this happened, January 25th, 2023, at $572 million, $572 billion, excuse me, down to $48 billion by May 31st, 2023. So that's about 4 months, January, February, March, April, May. It took about 4 months for the account to be emptied. So we can expect we're at around the same level right now, about $600 billion it shows here. Maybe a little bit higher than that, but it's going to take about 3 or 4 months, depending on how fast they spend down the balance. And once that balance is spent down, they're going to have to raise this debt ceiling. Once they raise the debt ceiling, this black rectangle here, this was the extraordinary measures that I showed in the previous slide. So the extraordinary measures happen in this rectangle, and you can see the blue line here is the Treasury's account at the Fed as they spent down that balance. Reverse repos were at about 2 trillion dollars. And then once the Treasury's account ran out and they raised the debt ceiling, the Treasury raised a whole bunch of cash over here from about 48 billion to about 800 billion. So let's just say $750 billion. And reverse repos fell by about $1.4 trillion in that time. You see, now the difference is there are no more reverse repos, at least they're not substantial. I think they are below 100 billion. They're not really significant anymore. That has been emptied. So if the Treasury wants to raise a whole bunch of money after the debt ceiling is raised, where are the dollars going to come from? Last time they came from reverse repos. This time there are none. So where are they going to have to come from? They're going to have to come from here. The bank reserves. This is the 3 trillion point something bank reserves. I think it's about 3.3 trillion now. The crisis line is $3 trillion, which I've shown before. That is the number we were at during the March 2023 regional banking crisis. If we break below this line for any substantial amount of time, let's say a month or two, we're going to have the final crisis on our hands, and QT, as that continues, is going to bring that closer and closer. So what's going to have to happen? The Treasury is going to have to spend down its balance of about 7. Gold is money, period. When you are exchanging a dollar for a pack of gum or groceries or whatever, what are you exchanging? You're not exchanging a piece of paper. You're exchanging a gold substitute. You're exchanging the gold or silver value of that dollar for the goods and services that you're buying. And why must this be true? This is true now. It's true always because of something called the monetary regression principle. The only reason you know what prices are now is because you knew what prices are yesterday. Otherwise, prices would be completely arbitrary. And if they are completely arbitrary, then there's no way to divide goods and services, and division of labor breaks down. The purpose of money is to divide goods and services according to supply and demand. Otherwise, there's no division of labor and you can't have an economy. So you have to go back in time. So the question is, how was the dollar born? And some people could say gold standard, but that's not even that's not true. The dollar was born as a silver standard, and then it was changed to a gold standard as a transfer of wealth from the middle class who owned silver to the wealthy who owned gold. But let's just say that the dollar started as a gold standard. Why? Because barter started by exchanging one thing for another thing. That's how society began, or economics began. and the thing that was most exchangeable for other things just happened to be silver and then gold later. So even now, when you're exchanging a dollar, you're exchanging a gold substitute. It happens to be a very inflated gold substitute. And we know what happens when the illusion of the dollar's value of gold, when that illusion is broken, then there's a depression, because that's what happened in 1933, right? Gold went from 21 to 35 as an admission by the government that this exchange rate is not real, and therefore we have to change it. And then you had a big, Great Depression. The real price of gold, the monetary price of gold, is what price would it be if everyone on the planet were to exchange all their dollars for gold right now? What would the price have to be? What would the exchange rate? It's not even a price, it's an exchange rate. What would the exchange rate between gold substitutes and gold have to be? And the answer is probably around $35,000-$40,000 to make everyone who wants gold, to have it. That's the monetary price. The price that we see on the futures exchange, that's the industrial price, because not everyone needs gold for industrial purposes, but everyone needs it for monetary purposes. Just they pretend that the dollar they have is gold, but not these exchange rates. The end game, we've seen it many times in history. Exactly how it's going to come to pass this time, I don't know, but I can imagine that it will be something like we've seen before, but global. What have we seen before in the end game? The end game is what the Austrian economist Ludwig von Mises calls the crackup boom. So we know what booms are. Booms are when economic activity in fiat currency terms picks up, and it looks like everyone's rich because the spending, the GDP goes up and blah blah blah. But GDP is really just another count of the money supply, because if you increase the money supply, you're going to increase the amount of dollars that are spent in an economy. It's kind of stupid. So the crackup boom is otherwise known as hyperinflation, when the economy speeds up the economy. It's not really the economy, it's the amount of money substitutes being circulated in an economy. Speeds up to the point where the desire to hold cash balances as money itself falls to zero. And once the desire to hold money substitutes themselves falls to zero, then people are willing to spend an infinite amount of money, or infinite amount of currency, I should say, on anything, just to get rid of it. So that's the crackup boom. That's what we're headed for. And it doesn't matter if we're talking about central bank digital currencies or paper money or whatever. It's all the same crap. It doesn't make a difference. I mean, people make this big deal out of central bank digital currencies, and it's a big deal in the sense that it robs everyone of any privacy whatsoever. But it's all the same fiat. So when it all goes to zero, that's it. It's all dead. It's all the same. So the crackup boom is going to be something along the lines of what happened in Weimar, what happened in Zimbabwe, or what happened in any hyperinflationary country, except everywhere all at the same time. And what happened then in Weimar, Germany, you could buy, for example, a mansion in Berlin for like 4 or 5 gold coins. So I expect the people with physical gold to be able to amass huge amounts of real resources, and that's when the purchasing power of gold and silver goes through the roof. In the initial phase, when the real breakdown happens, it's going to have to be physical, because all trust in all money substitutes will be broken. It's not like people are going to have this revelation, oh, I understand what money is now, and I get what Rafi's saying when he talks about the monetary regression principle, and they're all going to suddenly study Austrian economics and become geniuses in economic theory. That's not what's going to happen. What's going to happen is the same thing that happens in every bubble. Whether it's Bitcoin, people chase Bitcoin because it's going up. People chase this stock, Tesla, whatever, because it's going up. People are going to chase gold and silver, not because they understand what money is, because it's going up. And it's going up because this is the end game, and it's money. So people are going to try to chase it. They're going to try to get as much physical as they can. They're going to call for delivery. There's going to be a run. There's going to be, dealers going broke. They can't get supply, and there's going to be panic. And then the prices of everything are going to go way, way, way down in terms of physical gold and silver, because everyone in the world's going to want it. In the book, The Theory of Money and Credit, Mises says that we have to go back to exchanging physical coins. I don't think it's going to stay that way forever, but in the initial phases where prices are just off the wall and bonds are collapsing and this and that, then no one's going to accept anything for any of their services in return, goods and services in return, except for coins. So you're going to need some of that. Are you going to need like huge mansions full of it? No, because I don't think it's going to last forever. Until someone's going to offer to store your gold and silver for some meaningful substitute, and then substitutes will come back to life, and there will be more trustworthy ones and less trustworthy ones. That's what it should be. Instead of a monopoly on the substitute supply, there should be competing currencies, and the dishonest ones will go out of business and the honest ones will live. There should be a free market in money. That's what I think is going to happen. I hope. Make sure that you're actually buying physical gold or physical silver. It doesn't really matter what kind. In the end game, when the end game really does come, ETFs are not going to help you. Forget it. Whether it's Sprott or GLD, Sprott is more trustworthy, yeah. But like, if everyone's desperate and everyone calls Sprott at the same time saying, I have PSLV, I have PHYS, please give me my gold, Sprott's going to say, sure, here, it's going to mail it to you. It's not going to happen. Okay. I'm not saying it's not there. I'm saying you're not going to get it. You're going to have paper gold. And what are you going to do with it if the dollar can't buy anything? GLD is useful if you're trying to speculate using gold, right? And I do that. I don't do it with a huge amount of money, but if you want to play the options in the gold market for speculative purposes, then GLD would be the one to do. If you want to buy gold, GLD is not what you want to use at all, and neither is PHYS or anything from Sprott. So gold mining stocks, it's less of a problem to have ETFs because the ETFs are just baskets of shares, and there's much less of a chance that they're cheating and not actually holding the shares that they say they hold. They probably hold it. The question is, like, what happens to mining shares when there is an end game? And what I think is going to happen, and why I advocate holding mining stocks in the first place, is that when the currency collapses, and it will collapse to zero, then the gold mining companies and silver mining companies will be practically the only companies that can pay you real dividends. How? With gold and silver certificates of their product, because they'll have the money and you'll be able to earn real dividends, and maybe they'll mail out certificates, and you can talk to your company and say, here's my certificate, mail me the gold. And when things settle down, eventually you'll probably be able to get it. Whereas with ETFs, I don't think so, because they're owned by banks. So you don't want to mess with those unless you're speculating on the gold price, which you can do. I just don't recommend it for an end game scenario.